Look, if he can get the price of gold up a lot at $20,000 an ounce, if they can do things that make the market bid gold to 20,000, and people used to think that was insane, but I got to tell you, at $100 a day, it's looking less insane. 50 to $100 a day moves on the upside is looking a lot less insane than it was, say, 6 months ago. But if he can get it to $20,000 an ounce, which, by the way, would only put it back to 1989. Excuse me. It would only put it slightly above the long-term average of gold's price relative to the foreign portion of our debt. The market value of U.S. official gold relative to foreign debt. $20,000 an ounce would deposit roughly $5 trillion into the Treasury general account, free and clear. It's just straight money creation using gold. It's an accounting entry.
Gold breaking above $4,100 alongside a rising dollar signal. As financial strategist Luke Gromen sees it, the unravelling of the post-1971 dollar system. Luke argued that the recent surge in gold prices, despite already climbing more than $100 to above $4,100, has not yet fully captured the magnitude of the underlying shift. He stressed that China's decision to cut off rare earth supplies to Western defense systems marks a turning point, forcing the West to confront its own vulnerabilities. In his view, this move has effectively institutionalized a broader reset, where gold now replaces U.S. Treasuries as the primary reserve asset for global central banks, a structural change that he believes will not reverse. Luke Gromen further emphasized that this transition does not mean the dollar will vanish from global use. Rather, it will continue to serve as a transactional currency, but its purchasing power will steadily erode when compared with gold. For Gromen, today's market moves reflect the beginning of a permanent reordering, with gold reclaiming its historical role as the foundation of stability in global reserves. Luke Gromen connected these developments to the Brent's milkshake theory, noting that both the dollar and gold can rise simultaneously, a phenomenon foreseen decades ago by monetary theorists known as another and friend of another. He explained that as dollar borrowers are squeezed to repay trillions in debt, the rising value of gold serves as collateral, creating the liquidity needed to escape dollar dependence. This dual rise, he argued, is the clearest signal that the current dollar system is approaching its end, and that gold is once again central to the next phase of global finance. If you found this video helpful, don't forget to like, share, and subscribe to stay updated. We'll continue delivering sharp insights and expert perspectives on the forces driving gold, silver, and the broader financial landscape. Thanks for watching.
I think still not fully digested. Might be being digested by the gold market this morning, which is up $110 as we speak, over $4,100 on the futures. But that's got a lot more to go, in my opinion, to properly digest that message. So I think it's really important in terms of what just transpired, because they're basically saying we're done selling rare earths into Western defense systems. Get your own rare earths. Milkshake theory is absolutely correct around initially gold going up with the dollar. Something I posted a long time ago on X, and people familiar with the FOFOA blog and the readings of monetary theorist another and friend of another will recall that in the late 1990s, another friend of another said that when the dollar system is coming to the end of its life, you will see the dollar and gold rise together. That will be the sign that the dollars, because people will be getting squeezed into the dollar at one hand, but they'll also be getting out and going into gold. And so when those two things are rising together, that's the symptom of the end of the dollar system. That was said 30 years ago, almost 25 years ago. And so, yes, the milkshake theory will see the dollar squeeze higher. I get it. And gold as well. And gold, once it hits critical tipping point of price, and I don't know where that price is, but you can see hints of it. Albert Marco on X has said, hey, above $3,000 on gold, it starts to create a problem for the dollar. He was right. The dollar went down to 96. It says above $5,000 on gold, it creates a problem for the dollar and for the Treasury market. He's probably going to be right. And the point here, or what he's saying when he says that, is ultimately, yes, there is this, we've talked about this, $13 trillion dollar denominated liability out there, right? In terms of foreign borrowed dollar debt, that when the dollar goes up, it squeezes people into that. It forces them to sell treasuries. It forces them to sell U.S. equities to raise the dollars to get that. Well, once the price of gold gets high enough, it starts to fully collateralize their dollar liability on the other side. And suddenly it starts to provide the liquidity. It starts to be the sink. And that is how you circumvent the gold is how you get out of the dollar system. And that's why another or a friend of another said all those years ago, when you see them go up together, that means the dollar is coming to its end of life. This present form of this dollar system is coming to the end of life. Now, does it mean the dollar is going to die? No. I'll be using dollars, and your and my grandkids and great grandkids will still be using dollars. They're just going to buy us a lot less. And certainly in gold terms. De facto, we can see gold with today's price move has overtaken treasuries in global central bank reserves, right? So there's now more gold in global central bank reserves than there are U.S. treasuries. How do you sit there and argue and say, it's not overtaken the dollar in the system? To me, that's crazy. Now, will people still use dollars? Of course. Why? That's just Gresham's law, right? I hear people say, well, it's still dominant. 90% of currency usage, that's dollar dominance. Great. So you're spending, you're telling me it's the bad currency, right? I'll spend dollars all day long because there's a terrible store of value. But if the whole change of structure we've been talking about for years, and I mean, if you look at all my posts, all my podcasts, everything I've ever said, I've never said end of dollar reserve status. It's end of the post-71 structure of dollar reserve status, which is dollar as primary reserve currency, treasury bond as primary reserve asset. It happened. It's happened. The dollar is still primary reserve currency, but gold is now primary reserve asset as of probably this morning with the $100 move. And I don't think it's ever going back unless she suddenly decides to be, Yeltsin and, sell off his country for pennies on the dollar to American, corporate and Washington interests. And Putin decides to do the same thing because we can't go to war to stop him.
Luke Gromen outlined how a dramatic revaluation of gold to $20,000 an ounce could give the U.S. a financial lifeline by instantly adding $5 trillion to the Treasuries account. This accounting shift, without selling any physical gold, could slash debt-to-GDP ratios and provide years of fiscal breathing room. However, he cautioned that such a move would come at the expense of global dollar and stablecoin holders, whose purchasing power would erode, and stressed that the U.S. would have to act quickly as interest costs continued to spiral. At the same time, Gromen tied this financial scenario to geopolitical realities. He argued that China's decision to halt rare earth supplies to the U.S. military signaled a decisive break in the global order, institutionalizing a shift that forces the U.S. to secure its own defense resources. Rising gold prices, now occurring almost daily, serve as confirmation that the monetary reset is already unfolding, driven by China, Russia, and the BRICS bloc, while gold emerges as the anchor of the new system. Let's get back to the interview.
Yeah, I think that's exactly right. And historically, if you messed with the monetary side of the rules-based global order, the U.S. would send the military over and kick your head in. That's it had a big part of why Saddam was invaded, a big part of what Gaddafi was doing, as we know from Hillary's emails once upon a time. And the Chinese have been doing this. And so they've seen the message, which is when we try to change, which they have to, because again, they're not doing it because they hate us. They're doing it because they will literally have a late 1990s Southeast Asia crisis where China collapses like you saw Southeast Asia do, if they don't do this. And so they have understood the order of operations, which is if we're going to do this, we need to make it impossible for the U.S. to come over here and kick our heads in. And that's what this is about. And to me, the rare earth card being played in April or May, whenever that was, and we wrote about it at the time, is essentially we're done selling rare earths to the U.S. military. And that was my interpretation of it then. This institutionalized it. This is basically, it's now in black and white. And if that's the case, then the window's wide open for the system to be reset. And I think sort of, number 1A on the list of symptoms that you would see as the system is reset in a manner that China, Russia, the BRICS would like is, I think you'll come in and you'll see the price of gold up on every day that ends in Y. And that's what we've been seeing over the last, month or so. Today, no exception. So, I think it's a huge deal. I do think that Trump with his tweets when he tweets impulsively or posts impulsively, he usually gives you something that he probably shouldn't either, or that that is incremental information. So last week, just very serious people saying, "Hey, we're hearing she had a stroke. We're hearing she's being deposed." Well, Trump just told you that she had a bad day and made a mistake. So she didn't have a stroke and did not get deposed, per the president of the United States and his post. And then the other thing is we have heard chapter and verse from Trump, Bessent, Lutnick over and over about how we have all the leverage. That post just told us, no, we don't. Now, again, that's not a surprise per se, but that takes us from denial of the denial stage of grief about who actually has what level of relative leverage into somewhere between anger and bargaining, right? It's, he threw his fit, then he's like, well, it'll be, we don't want to put China in a depression and we don't want to put ourselves in a depression. That's exactly right. We'd put them both in a depression. So, let's de-escalate. But again, I think it masks like the number one key thing, which is we got to find our own rare earths for our own weapon systems. That's what the stablecoin gambit is. Now, what else can they do? Look, if he can get the price of gold up a lot, at $20,000 an ounce, if they can do things that make the market bid gold to 20,000, and people used to think that was insane, but I got to tell you, at $100 a day, it's looking less insane. 50 to $100 a day moves on the upside is looking a lot less insane than it was, say, 6 months ago. But if he can get it to $20,000 an ounce, which, by the way, would only put it back to 1989. Excuse me. It would only put it slightly above the long-term average of gold's price relative to the foreign portion of our debt. The market value of U.S. official gold relative to foreign debt. $20,000 an ounce would deposit roughly $5 trillion into the Treasury general account, free and clear. It's just straight money creation using gold. It's an accounting entry. Wouldn't have to sell any gold, whatever. And then you could buy down a pretty big chunk of debt. He can go out into the market and say, I'm going to, either he can finance the U.S., the long end needs with that $5 trillion for 5 years at least, probably more like 8 years, or he could just go in and immediately say, hey, I'm going to buy back $5 trillion worth of the $29 trillion out. That's going to take down 20% of the market. So debt to GDP is under 100 right away. Assuming a money multiplier, nominal GDP is probably going to run friggin' 15, 20% for a couple of years. Debt to GDP will be back to 50, 60% in a very short period of time over the backs of, the purchasing power of stablecoin holders around the world. So they could do that, but boy, they got to hurry because, Treasury, interest doesn't sleep.
Simultaneous strength in gold and the dollar highlights deep fractures in the existing system, where rising debt burdens and collateral stress are pushing toward structural change. China's strategic use of rare earths, along with the growing influence of BRICS, reflects a calculated move to reduce U.S. leverage and secure a multipolar order. With gold now surpassing treasuries in central bank reserves, the long-standing post-1971 framework is giving way to a model in which gold reclaims primacy as the reserve asset. Market-driven revaluations, or even deliberate policy choices, could accelerate this transition, leaving the dollar still widely used but steadily weakened in value, while gold becomes the stabilizing foundation of the evolving monetary system. Could a deliberate revaluation of gold become the most viable path for managing unsustainable debt levels while reshaping the global reserve system? So, stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thank you for your continued support, and we hope you enjoy the video.